Welcome to Whole Life Insurance Mechanics from the perspective of Nelson Nash's infinite banking concept. I'm Ryan Griggs, your host and lecturer. This is part 4 of our 7-part series. This one is on non-forfeiture options and policy loans. Here's our overview. What does a non-forfeiture option, or NFO, even mean? This is how I'll abbreviate it, NFO, non-forfeiture option. We'll then go into some of the types. Number 1 is our reduced pay-up. And these are presented in a certain sequence or order, which I'll tell you why they're presented in this way in just a moment. But we have changing the dividend election or partial surrenders. These two combined are often called, or when they're combined, it's often referred to as premium offset. Well, then we'll talk about policy loans. I snuck policy loans into this non-forfeiture option context because to a company, that's in a sense what a policy loan was originally used for. Obviously, we're in IBC land, and policy loan, of course, we're becoming our own banker. We're using policy loans to finance other things, but there's a sense in which a policy loan can be a non-forfeiture option. So this is a good time to bring it up. We'll talk about what Nelson Nash recommends for using your policy. And because we're going to talk about policy loans, of course, we're going to talk about policy loan interest rates compared to interest rate regimes on conventional credit instruments. And like I left a little carrot at the end last time, this is where we'll talk about why policy loans are the most efficient credit instruments on the planet for like the normal people. Okay. If you're a commercial bank president, the world's different. But for you and me, the most efficient credit instrument on the planet is a policy loan, and we'll explain why. A non-forfeiture option is an option. It's a method of keeping some or all of your death benefit, your face amount, your insurance, your coverage in force without the need to continue to pay money out of your own pocket. So it's an option to not forfeit the policy, but I don't have to pay additional premiums. And it can be for 1 year, it can be permanently, but a non-forfeiture option. And these are right, look, I'll tell you now, one of the punchlines here is certainly my clients, but in general, you're probably not going to use all of these. Well, you're definitely not going to use, well, I'm going to be exact here. I'm virtually certain that you're not going to use all of them in the life of a contract, though you certainly could, I suppose. But the reason we're going over it is because these are your rights. You should know the various methods in which you can manage a policy. Oftentimes, look, in finance, we should be concerned with the worst case scenario. Nelson used to say, as many have, live as if you're going to die tomorrow, plan as if you're going to live forever. And that's great, but we would like to know what goes wrong in the or what can we do in the event that something goes wrong and we have a worst case scenario situation. How do we keep the policy enforced? How do we keep from hurting ourselves? How do we keep from other things, causing problems for other people? Okay, all questions that are typically not addressed in a conventional financial analysis conversation because, of course, conventional financial planners don't have an answer for business cycle risk. Right? When the value of the market correlated asset, when the value of the stock portfolio falls off a cliff because there's been a recession or depression, as there tends to be every 5 to 10 years or so throughout American financial history, what then? Well, they tell you, you got to be in for the long run. Just keep your money in there, wait it out. It's sort of a black box answer. Just hold on, things will get better. Okay. Well, in contrast here, we're going to talk about some specific things that you can do to manage your policy in the event that, say, I refer to these as like an income disruption. And it can be of whatever severity. If you have a super severe income disruption, can't pay any premium, what happens? If you have a momentary disruption in income, you're changing jobs, but you expect income to come back, or there's a down year in the economy, your business is very cyclical, revenues are not what you thought they would be, what happens? Right? What can you do to keep the policy enforced, to keep the system intact, to keep the infrastructure intact? And this all falls under the umbrella of non-forfeiture options. What to do when things go wrong. We're going to talk about them in a particular order. We're going to refer to the most restrictive, least efficient non-forfeiture options first. And then we're going to move to the least restrictive, most efficient later. Okay, so as this list goes down, it's essentially in a rising order of preference, or a descending order. What would it be? The later ones are more preferable, in my view, but we'll explain why. Don't be NFO trigger happy. If I had a nickel every time I found a video online of some advisor showing a policy illustration where the policy goes RPU in year 8, I could pay a big premium. I don't, unless there's a specific circumstance why we want to shut off premium, why we want to stop contributing to our ongoing cash value, our ongoing capital growth. Or there's a specific request from a client. Why would we want to shut premium off? Why would we want to assume the use of a non-forfeiture option in that case? I think maybe one reason is because there's a bit of conventional thinking going on that says premium is bad. In the normal life insurance policy purchase process, the question is, how much death benefit can I get, and how little can I get the premium to be? It's an anti-premium type of conversation. I was having a call with a client the other day. Has yet to read Becoming Your Own Banker. I'm encouraging him to do that. But was sort of under this spell of conventional thinking still that suggests that, how much coverage am I going to get? What's the premium going to be for that coverage? And that's an offshoot. It's a manifestation of this thinking that, premium is this thing that we have to pay to get some death benefit. And especially with the term world, where we're essentially renting death benefit, we want to pay as little premium as possible for the same death benefit dollar. But that is not what we're doing in IBC. In IBC, premium is a good thing because premium is a contribution to capital. This is economic terminology. This is not formal, financial industry terminology, but I'm saying this is when you pay a premium, you're contributing to your capital. I could write a little clearer, that'd be helpful. And contributing to your capital is a good thing. We're building up capital, cash value, in something that we own and control, and you've never heard of an overcapitalized business. In fact, when we talk about someone who has too much money, what we're often referring to as someone, as James would say, who has living problems. You give them money and they go out and get into some bad way. Like, okay, well, that's another problem, right? The problem isn't per se too much money, too much capital. There's other issues. That's why I say you've never heard of a business that's overcapitalized. Can't have too much access to money, all else equal. That's this third point here. We want to maximize our capital generation growth. Look, if you're using a non-forfeiture option, unfortunately something has gone wrong. And we're so conditioned in conventional finance to think when something goes wrong, it's like the house is going to burn down. Okay, in life insurance, dividend paying whole life built appropriately for the IBC is so robust that if something does go wrong, and you've got you've had a solid conversation with an advisor, you become well informed, there are all sorts of things you can do to manage that event, to manage whatever has gone wrong. people who, look, the fact of the matter is, in conventional finance, the individual doesn't have hardly any control. The contemporary financial industry says their whole compensation model is called assets under management. Your assets under their management. They manage them. They control them. And so you get into government plans, there's all sorts of additional restrictions. Right? There's a sense in which like conventional American finance is about fleecing you of your control over money. Okay, and everything else is viewed as alternative or contrarian or different, going against the grain, which naturally scares people. Right? We're fundamentally tribal, and the idea of being out there, being an outsider, going against the grain is like scary. And I get that. But in that world where we don't have a lot of control, it's like a flight or flight fear response. When something goes wrong, it's like hunker down, freeze. The senses become much more urgently magnified. We're very concerned. My point here with this lecture, what I'm hoping this achieves, is to show you there are all these various things, all these options, all these non-forfeiture options that you as a policy owner have a right to enact to keep things in force, to keep from hurting yourself, to keep from anything happening, to keep from the policy disappearing, to keep from triggering a tax event. Yeah. Your goal in life should not be to minimize your premium. So don't be NFO trigger happy. All right, number 1, reduce pay up. Look, we talked about how on lecture 2 on policy infrastructure, the base policy consists of base premium, a schedule of premium payments from the time the policy goes in force until a year in the future where the policy where the initial death benefit is paid up. Right? The base policy has the base premium. It's got this initial death benefit. And at some point in the future, that initial death benefit, that initial face amount will be fully paid for. It'll be fully paid up, right, at age 95 or age 100, some age of the insured way into the future. Okay, well, the reduce pay up non-forfeiture option is a way of bringing that paid up year closer to the present. Okay, if I have a policy that's paid up at age 95, and I'm 10 years into a policy, and I want the death benefit to be fully paid for. In other words, I don't want to have to pay additional premium in the future. I could reduce the year in which the policy is paid up to, in this example, year 10. Okay, so that's all reduced pay up is. I'm reducing the year in which the initial death benefit becomes paid up. Put differently, though, RPU is a permanent prohibition against future premium payment. Okay, if I fully paid for the death benefit, well, it's paid for. So there's not going to be other premiums in the future. Like, okay, you don't have to pay premium in the future, but you also can't pay premium in the future. And if premium payment's a good thing, well, then maybe I don't want to do that. And it does come at the price of a severe reduction in death benefit and cash value. If I had a policy that was supposed to be paid up at age 95, and I'm at year 10, and I want to say, no, I don't want to pay any more base premiums from now until the year in which I turn 95. I want to reduce pay up. It's like, okay, but the life insurance company was expecting this big old string of future base premium payments. So if you're saying, look, I'm not going to pay it, well, then the company's going to say, well, then we're not going to pay this big old death benefit. We're going to reduce that death benefit. And remember, cash value is the net present value of the death benefit. So if the death benefit goes down dramatically, as happens with an RPU, then so too must the cash value. So that's why we have a severe reduction in death benefits and cash value. The later on in the life cycle of a policy you engage this RPU non-forfeiture option, the lower the reduction in death benefit and cash value, because you've made it through more. Remember the squiggly line? My Monet, Da Vinci squiggles, right? From policy start, you've paid base premium. It was supposed to be paid up at a certain point, and if you pay up much earlier, then there's been some cost. There's been a large bit of cost that you haven't paid. But if you reduce pay up much closer to your original paid up date, well, then the cost that you've yet to pay is smaller. And so the reduction in the death benefit will be lower. Okay, so just in general, if you reduce pay up later, the reduction in cash values and death benefits will be lower. If you reduce pay up sooner, they'll be higher. I say it's the most restrictive and the least efficient because it is. It's permanent. Can't undo it. Can't resurrect premium payment in the future. If you want to pay more premium in the future, you got to go get another policy. Yet, I see this all the time online. RPU in year 8, in year 10, in year 20. Why? We're scared of paying a premium. What was one of Nelson's rules? Don't be afraid to capitalize. What's premium? Contribution to capital. An implication of the rule, don't be afraid to capitalize, is don't be afraid to pay a premium. And in all those online things where the justification for why something would be RPU'd is absent, it's revealing a fear of premium payment. Oh, and by the way, statistically speaking, does income in general go up over time or down? The answer is up. Peak income generation time varies person to person, region by region, but in your 60s, let's say, early to mid 60s, so when we're the most competent in our field, we've accumulated all this knowledge, we've practiced this skill, we have this network, right? The value of a hour's worth or a unit of time's worth of labor can accomplish a lot more, is more productive, therefore earns a higher wage in economic terms. Therefore, income is higher, statistically speaking, economically speaking. So why would I want to shut off premium? Why would I want to, when I'm earning the most, generally speaking, all else equal, why would I want to, at that point, shut off my ability to channel that income into my bank? I don't understand that. But it's all over the place online. Okay, RPU, it's there. When might an RPU be used? Well, certainly after the first 7 years. Remember, if you can fully pay for the death benefit within the first 7 years, policy's a mech. So RPU is available day 1 of policy year 8. Some companies may differ. I'm not aware of all the differences across companies, but some may, year 10, I don't know. But theoretically, it's available after year 7. But after year 7, okay, when might I use it? When I'm certain that my incoming cash flow, not just my income, not just my wages from work, but my rental payments, my interest payments, when I'm certain that there will be no cash flow or insufficient cash flow such that I'll have no demand, no desire to channel that money into my own personal monetary system. And I'm certain that my cash flow will never recuperate in the future. Because again, this is permanent. So, okay, that could happen. Is there never a time to use RPU? No. Double negative there for all my language fans. It's possible that there's a time and place to use an RPU. Is it the case that we should use it as often as it's shown online? Probably not. But it's an option. It's available. In my opinion, it's the least favorable. Number 2, premium offset. You'll hear this online sometimes, though with less frequency than the RPU. There are typically 2 meanings. The first is a change in the dividend election, and the second is a partial surrender. Okay, so a change in the dividend election. Recall in the policy infrastructure lecture 2, we briefly mentioned dividends. We said that we have dividend allocations. Let me put this up on top. We have dividend allocations, or dividend elections as they're formally called, but this is where the dividend is allocated to. Normally it goes to PUA. Well, if I have an income disruption in a given year and I can't pay my premium in that policy year, one thing I could do is tell the company to change the dividend election. I can tell the company, look, allocate the dividend to my base premium. Whatever dividend you were going to send to the PUA, don't do that. Send it to base so that we lower how much must otherwise be paid in that year. Now, early on, certainly for the first several decades, well, maybe not several decades, first 10 to 30 years, depending upon your premium payment and the structure and who you are. But for the earlier years of a policy, the dividend payments likely will be less than the base premium due. So if I just were to change the dividend election to the base premium, well, there's still more money that needs to come from somewhere. I could just pay that out of pocket. Right? I could in a sense do like a partial premium offset, like change the dividend election, use that to lower the base premium, and I'll pay the rest out of my pocket. You could do that. But in most cases, when we're referring to a premium offset, what we really mean is use the dividend to lower the amount of base premium payable in a given year, and then to get the rest of the money, reverse some past PUA payments. In other words, partially surrender some of the death benefit that I purchased with my own PUA in the past. Give me a refund for that paid up death benefit I purchased in the past, and use that money along with the dividend to take care of my base premium in a year. That's typically what we mean by premium offset. Changing the dividend election, and then whatever's left over, go surrender some previously purchased paid up death benefit, and surrender exactly the amount necessary to generate the sufficient funds to cover the margin of the base premium that remains to be paid. And you could imagine a scenario where we reverse this, where it's like, look, leave the dividend going to the PUA, right? Its own dividend has its own PUA channel. Remember, dividends going into a policy through PUA typically does not affect your ability to pay PUA out of your own pocket. So let the dividend go back to the policy through its own PUA channel to buy more death benefit and generate cash value. Let that happen. But then to cover my base premium for the year, I want a partial surrender. Meaning I want to surrender enough death benefit to generate exactly what my base premium otherwise would be, and use that money to pay the base premium so that I don't have to pay something out of pocket. You could imagine that. And a policy owner gets to choose. You can change the dividend election. You can tell the company, look, I want to pay the premium via partial surrender. It's just that this terminology of a premium offset often refers to a combination of the two. Doesn't have to. You're going to reach a time later in the life of the policy where the dividend is greater than the base. Well, again, proper policy design, well-funded premium. You get late into the life of the contract. The dividend's greater than the base premium. You could theoretically use the dividend to pay the full base premium. And in fact, there might be some dividend left over beyond what the base premium is, and you could use that to send back to the PUA. And I've noticed that some people, that's their goal. No. My encouragement, do what you want, right? It's becoming your own banker. You can do what you want. But no, like Nelson said, on his State Farm policy, he offset the base premium with the dividends for 15 years. And if he could do it all over again, he wouldn't. He would have had the dividend go back into PUA, and he would have paid the base premium out of his own pocket. Which is what, don't take my word for it. That's what Nelson encouraged you to do. But then he gives the reason. Why? Because the dividend contributes to your ongoing compounding growth in your contract. And as that cash value grows, cash value is what you can get to by policy loan, or you could even surrender in the future. So the more cash value you have, the more you can get to in the future. So the greater the extent to which you allow dividends to go back into the policy through PUA to generate more cash value, the better. And so, if it's your goal to shut off base premium when you're 70, okay. Maybe. In dividend paying whole life, you have the contractual right to do that. But, maybe you say, look, maybe I have some cash. By the way, if things go well, and for lo and behold, for bankers, things tend to go well. If you're 10, 20, 30 years down the line, ideally you'd have some passive cash flow coming in from maybe some investments, and that money's got to go somewhere. Might as well be paid into dividend paying whole life. All right, so what are the effects on a policy of a premium offset? Well, in the case of a change in the dividend election, right, we're giving up cash value and death benefit growth we otherwise would have had. Right, so I say cash value and death benefit growth foregone. Okay, if the dividend goes to the base premium, all right, that's covering some of the base premium, great, but that means that there's some of the dividend that's not going to PUA. And PUA generates cash value by purchasing death benefit. So if there's some PUA that, well, if there's some of the dividend that would have gone to PUA that didn't, well, then I must be giving up some cash value and death benefit growth. So in a sense, there's an opportunity cost. And that's what I'm giving up when I change the dividend election to offset the base premium. And in the case of a partial surrender, the cost is more obvious. I'm reducing the death benefit and cash value. Cash value is the net. I keep going back to this. This is why we spent so much time on it earlier. Cash value is the net present value of the death benefit. If I partial surrender death benefit, I'm giving up some of this death benefit. It's going to mean a reduction in cash value. Now, here's a little tricky thought experiment. If I'm late into the life of a contract and my dividends are substantial and, 30, 40% of the cash value growth in a given year. I got substantial dividends down the road. And I have an income disruption. I really can't pay the base premium out of pocket. Right? So maybe I partial surrender. I'm going to surrender some death benefit to pay the base premium. It could be the case that late in the life of the contract, that the magnitude of the dividend is such that the increase in the death benefit is greater than the decrease in the death benefit necessary to partial surrender and generate funds for the base premium. You see what I'm saying? Like there would effectively be an offsetting situation where my dividend going back into the policy is buying so much death benefit that even if I surrender some of it to pay the base premium in that year, the net result is still positive in death benefit growth. That could happen. It's going to happen later in the life of the policy, right? It's not something you can do earlier on, first 10 to 20 years, let's say. But down the road, that's possible. Again, advise the thing that ideally you're paying the base premium out of your own pocket. That way we don't have to talk about net effects at all, right? We would want the dividend to go back into the policy, and we would also like to not surrender any of the death benefit. That's what would maximize our cash value growth. But compared to the RPU, certainly less restrictive. You could premium offset in the 1 year and then pay the full premium in the next year. It's not like once you start premium offsetting, you have to do it forever. Like with the RPU, you do it 1 year, well, then that's it. No further premium in the future. But if you premium offset, that you can do that 1 year, and then in the next year, you can pay the full premium. Right, so second most restrictive, second least efficient. And when I say efficiency, I'm just talking about the magnitude of death benefit that you have to give up, or the magnitude of death benefit growth foregone. Right, that's lower in the premium offset world than it is for an RPU. Policy loans. We've referred to them in the past lecture. Again, this is why this course is structured this way, right? That we should be naturally leading into the next subject. But just to be technically clear, right? When in a policy loan, a policy owner borrows money from the life insurance company. Okay, we are not borrowing money from the policy. That is what we are not doing. In a policy loan, we are not borrowing money from the policy. We are borrowing money from the life insurance company. Okay, this is an investment from the perspective of the life insurance company. Just like the life insurance company lends money to other entities in the marketplace, when a company lends money to you, You have an indebtedness to the life insurance company. That is an account receivable to the life insurance company. They expect to receive money from you. Right? There's going to be you'll pay interest. That interest is interest income. A policy loan is in a sense a distinct, segregated transaction from the policy per se. And how does that happen? Well, when we borrow money, the life insurance company puts a lien against your death benefit. And this is, I'm being nitpicky here, but just to be technically clear, when we say that we're going to take a policy loan and it's collateralized by the cash value, that's indirectly true. Let's put it that way. That is indirectly true. Look, the lien is not against the cash value. The lien is against the death benefit. If you fail to repay the policy loan, the company doesn't take your cash value. Okay, the company is going to deduct the death benefit. The cash value is just what the death benefit is worth today. The cash value tells you how much of the death benefit you can instruct the company to place a lien against. You know, if we take an example from the housing world, the collateral on a mortgage is not, well, let's use the home equity line of credit. The collateral on a home equity line of credit is not the equity in the home. The collateral on a home equity line of credit is the home, right? It's the thing. The equity in the home just tells you the extent of your ownership in the home. And that's what the company's willing to lend against. Right? That's the value of the home that the company's willing to lend. Let's say that again. That's the value of the home, the equivalent of which the company is willing to lend you. Now, there's loan to value ratios and all the other stuff, but my point is that the collateral isn't the equity per se. Cash value is equity. Cash value is capital. But the collateral technically on a policy loan is not the cash value, it's the death benefit. Now, I mean, I say this, right? It's collateralized by the cash value. It's shorthand. Okay, but it technically is the death benefit that is the collateral on a loan. Because if you pass away and that loan balance is outstanding, then the thing that's going to be deducted is the death benefit. Now, in the context of a non-forfeiture option, we might take a policy loan and use that money to pay the premium in a given year. Some companies even have what's a so-called default NFO, default non-forfeiture option. And one version of that is what's called an automatic policy loan, or APL. And just like it sounds, if you don't pay the premium, company can't get in touch with you, agent can't get in touch with you. Rather than let the policy lapse, the company, in the event that there's sufficient cash value, will take a policy loan and use that money to pay the base premium. I have a lot of clients. I don't know if it's the case for all my clients, but generally speaking, for my people, APL is the default non-forfeiture option. There's one non-forfeiture option that I didn't list here because while the industry technically calls it a non-forfeiture option, I wouldn't say that it is. But the other one is called convert to term. Meaning that if you don't pay premium, then rather than let the policy totally lapse, they take the amount of death benefit in force on that permanent insurance product and they change it into temporary death benefit with no cash value, because temporary death benefit doesn't have cash value, because temporary death benefit is rented death benefit. And there's no ownership, so there's no equity in a renter situation. It's conversion to term. The reason I didn't list it here is because we're no longer in the realm of dividend paying whole life. It's now a term policy. In my world, that whole life policy is no longer, there's no longer any permanent death benefit. But that could happen. If you're a policy owner, you should know what your default non-forfeiture option is. Is it likely that a company's never going to hear from you when a premium payment's due? Probably not. If you're practicing IBC, you're looking forward to your next premium payment. So this is unlikely. But look, the world is what it is. Say you're traveling abroad and for whatever reason you get stuck in that country and can't get back. And a policy date's upcoming and you're stressed out because you can't get back. So you're not thinking about paying a life insurance premium. Well, it'd be nice to know what the company's going to do if no one can get a hold of you. Especially if your cash value exceeds your cost basis. Right? You don't want that policy to lapse. If a policy lapses when the cash value exceeds the cost basis, you have a taxable gain. So we want to avoid lapse for sure. Now, in the event that the policy converts to term, is there a taxable gain? And again, I'm not a tax advisor, consult a CPA or something. My understanding is that no, that's not the case because the value is being used to buy a temporary product. I could be wrong, but we don't mess with conversion to term anyway. So my point is understand what your default non-forfeiture option is. This is another thing that's never talked about because it's like not a sexy thing, but you should be aware of what your default non-forfeiture option is. And if the company offers one, I think it should be automatic policy loan. In the event that you were to take a policy loan to get the premium paid, what happens? What's the effect on the policy? Well, first of all, we left the dividend alone, right? Unlike in the premium offset world, the dividend is allowed to go back into the contract. Right? So that's dividend goes back in the form of PUA. It's going to buy more death benefit. That's going to increase cash value. Great. We want that. We're also not partially surrendering, so there's no reduction in death benefit or cash value growth. All we've done is put a lien against the death benefit. Right? And so, consequently, we have preserved our cash value and death benefit growth. Now, there are these little asterisks here because that is not always the case. There's a thing called direct recognition. And for people with policies that receive direct recognition, which will be the subject of our next lecture, if there's a policy loan balance outstanding at the end of a policy year, then the dividend will be reduced. So there could very well be an effect on the growth trajectory of cash value in the event you use a policy loan as a non-forfeiture option if the policy receives direct recognition. But we'll talk about that more in a minute, in the next lecture. My point is that a policy loan can be used as a method of keeping the contract in force without having to pay premium out of your own pocket. And in my view, it's the most efficient and least restrictive one. Look, you can even go back and undo it in the future, in a sense. Right? If I use a policy loan to pay my base premium in 1 year because I've had a minor income disruption, and then in the next year things get better, well, not only can I pay the premium that I was ordinarily allowed to pay in that year, but I can go pay off the loan. Right? So I can get rid of the lien. It's almost like nothing ever happened. Nelson, this is some high-level stuff. I don't think I put it in here. I didn't. There's a Nelson quote, but you'll have to go get Building Your Warehouse of Wealth yourself. There's one little paragraph. It might be 3 sentences, probably 2, where Nelson Nash talks about getting a dividend-paying whole life product and taking policy loans for the first 13 years to pay the premium on the expectation that he was going to have a windfall in the future. In his case, it was from the sale of land, and he needed somewhere to put all that money. And he took the money from the windfall and he used it to pay off the policy loan balance that he had accumulated over 13 years. He goes on to say, why in the world would I do that? Well, because he initiated a capital generation process. He initiated a compounding growth process that lasted for 13 years. Now, there was a lien against the death benefit, but the value was growing. The value of the death benefit rose. Right? What goes on in a policy loan is we preserve the growth of cash value while also accessing the purchasing power of that cash value by putting a lien against the death benefit. Yeah, let that marinate for about 2 months. That's advanced stuff, but look, you made it this far into the course. I'll give you a little bit. That's in building your wealth stuff. Should everybody do that? No. You gotta really not. Don't be afraid to capitalize. Don't be afraid to pay a premium. Think long range. Right? You have to be fairly confident in the viability of a future cash flow. Nelson was a forester. He knew something about land. Right? Now, could there be a scenario where you know about your business and you know how the value of assets in your business change over time, and you know that you're reasonably confident that there's going to be a windfall in the future, and you're thinking about where that money ought to go? Well, maybe that example is more applicable to you. I'm just saying that's an extreme case from the founder, from the creator of the infinite banking concept, of using a policy loan essentially as a non-forfeiture option. He kept that policy in force, and he used policy loan. He would pay the base premium, but then he would take the policy loan to go use the money elsewhere. Right? It's the infinite banking concept, right? There's infinite possibilities here. Nelson, Becoming Your Own Banker, page 44, 5th edition, and car financing. Note that the illustration on page 46 and 47 does not show any policy loans to make car purchases. Hold on, wait, Ryan, you just told me that policy loans may well be the best way to access cash value. And Nelson is here acknowledging that on page 46 and 47, the method of car purchasing was not policy loans. In fact, to return to the quote, the purchases are made by use of dividend withdrawals. If I were in the life insurance business, I would never suggest that a client do it this way. I would recommend policy loans to buy the cars. There is a simple reason for this procedure. Remember, the earlier one starts a life insurance policy and the longer it stays in force, the more efficient it gets. When one surrenders paid up additional insurance, partial surrender, you are surrendering a small portion of paid up insurance that has recently been created. Hence, you are killing the growth potential of that much of the policy. If you use policy loans instead, then you are not terminating this potential. The policy values continue to grow. So you ask, why are you demonstrating dividend surrenders? Simply because there are many people that when they see the word loan, their brain goes into a deep freeze. Quote, loan means something bad, something I should not do, unquote. I just wanted to demonstrate that the concept could be done this way for the benefit of those who have that problem. To put all of this in perspective, study the financial statement of a conventional bank. Deposits to a bank are liabilities, something they owe to their depositors. Loans are an asset to the bank. It is the source of their income. The infinite banking concept is teaching you how to become your own banker. We are taught that all debt is bad, and I get it, because a lot of it is. But in fact, if we were to make that more nuanced, we would say debt that you do not control can be bad. Certainly, OPM, OMG. We have heard about plenty of OPM. Right? Everybody, other people's money. I get it. And has that made people rich? Sure. Down here, for the rest of us, having a whole bunch of debt to a commercial bank that we don't own and control might not be a good thing. There's the concept of debt slavery. Right? Isn't that an interesting concept? OPM is great. And then on the other side, well, yeah, but there's that idea of debt slavery. The problem for the reason that there's that odd dichotomy, like, wait, why would using other people's money be good when I could end up a debt slave? Well, the problem is that most debt is debt that we don't control. And this is really where we get into it. A policy loan is the only credit instrument on the planet where the lender is also the guarantor of the value of the collateral. I say read that again like a smartass. Look, think of this in the mortgage world. Imagine that a mortgage lender could guarantee what the value of your home will be in 30 years. Well, of course they can't do that. Homes or any property, almost every piece of property, is only worth what somebody else is willing to pay for it. And what somebody else is willing to pay for it is only revealed once that person actually pays for the thing. And there's a whole subfield of quote-unquote economics where people take surveys of what they value. It's made up. Who knows why those people say what they say? The only time we know what something is worth is when somebody else actually pays for the thing. It's the concept of revealed preference. So a mortgage lender can't guarantee the value of the home in the future. They have no idea what somebody in the future is going to be willing to pay. They might think they know, but at the end of the day, they don't. Meaning that at the end of the day, in all conventional credit transactions, there is a fear for the lender that there will be a default, that the borrower will be unable to repay the loan, and that the value of the collateral on the loan will be insufficient to cover the loss. That's pervasive. It's inextricable. Except in life insurance. In life insurance, the lender, the life insurance company, is guaranteeing the value of the collateral. The life insurance company is guaranteeing the cash value, which is the value of the collateral. Right? The life insurance company, one more step, is the company guaranteeing the death benefit. Life insurance is a unilateral contract. Payment of premium obligates the company to pay a death benefit. That contract is legally enforceable. The company is guaranteeing that they'll pay that death benefit. A death benefit is a future cash flow. Future cash flows have present values. Therefore, if the company is guaranteeing the death benefit, they're also guaranteeing the cash value. Right? The company is saying, look, we know you're going to repay us. You're either going to repay us while you're alive, whenever that may be, or when God calls you home, when you graduate, as Nelson used to say, we're going to deduct whatever you owed us from the death benefit. The company knows they're going to get paid. And this is why policy loans are so special. This is why there's no fear that the collateral on the credit instrument will be insufficient to cover the loss due to the default. The company knows they're going to get paid. Whereas in every other credit transaction, the lender is not certain that they're going to get repaid. All sorts of things follow from this, y'all. There's a concept called over-collateralization. Okay, when a commercial bank over-collateralization, I don't even know if it's a technical, I don't know if it's in the dictionary, but it's a common phrase. You go to borrow money from a commercial bank, and you got to put collateral. You got to specify what assets the bank could seize in the event that you default. Do you think that the bank is going to value those assets highly or conservatively? Well, of course they're going to undervalue them, right? They want to have much more collateral or more collateral on the books relative to your indebtedness to them. That way, in the event you fail to repay the loan and they have to seize the property and they have to sell it quickly, they can still recoup the loss from the loan that you failed to repay. If the value of the collateral was insufficiently high and they went to sell those assets to get back the money that you didn't repay them, well, then they may end up eating a loss. And a banker, if no one's going to eat a loss, it's a banker. So in life insurance, we eliminate that. Okay, so we can already start to see what that might mean for interest rates. Or not so much for interest rates, but for interest per se, interest by volume. If a conventional lender is concerned that they may not be able to sell the collateral on your note for sufficient money to get back what they lent you in the event of default, they're going to compensate for that risk. They're going to compensate for that risk by collecting more in interest from you. and you can call it what you want. You can call it origination fees. You can call it closing costs. You can call it whatever you want. Okay, the price of credit is interest, period. I don't care what the company calls it. Okay, there's all sorts of methods of camouflaging true interest cost by using other terminology, calling them fees or whatever. At the end of the day, the company has all, and they look for large companies, and especially in the era of credit consolidation and the financialization of the financial consolidation of capital, these companies have huge operations, and they can perform statistical analysis like the best of them. That's why most economists are employed at the Federal Reserve. But the companies know what the cost to them of default risk generally is. Now, of course, we have special moments like the subprime crisis and so forth where that wasn't the case. But generally speaking, right, the pricing of credit is not based on those punctuated disequilibrium points, in the history of modern finance. The pricing of credit is based on the ordinary experience of the companies. And if they know that they're going to have a certain amount of default and that's going to cost them a certain amount, well, then they're going to price their loans accordingly. They're going to set interest. They're going to set their fees and their closing costs and all the other made up ways of, asking from or demanding money from you. That's how they'll price them. They'll price them with that risk in mind. Look, what I'm telling you is that interest in the modern conventional financial environment is not just a matter of the time value of money. Right? It's not just a matter of waiting. Interest is in the conventional environment on real loans from actual banks, actual institutions in real life, is at least a combination of the time value money and however much the bank needs to charge to make good on default risk. Now, it could also be other things. It's a politically influenced, to say the least, industry, and so they're collecting, I'm sure, they're collecting as much as they can. Don't get me wrong. I'm just saying, theoretically speaking, even in a purely free market world where there's no government involvement in the pricing of loans or the regulation of banking, there's going to be this idea of, okay, we're going to advance money to them, right? There's a time value of money consideration there. That's going to cost something. And there's a fear of non-repayment. And that there's going to be a generalizable risk across our borrowers. And to some extent that can be quantified and we can pad the interest. Okay? What I'm telling you is that second part does not exist in policy loans because the company knows they're going to get paid. This is why policy loans are the most efficient credit instruments on the planet. You tell me, is there another credit instrument out there where the value of the collateral is guaranteed by the lender? No. And so what people will say, especially people who have never read Nelson, is like, yeah, well, I have a non-recourse loan. Okay. Yeah. Reflect to yourself. Are you going to go lend money to somebody, a stranger, by the way, without any sort of recourse? And that's going to be your business plan? No. You sign on a dotted line, all sorts of, and the thickness of the loan agreement should be an indication of whether or not there's truly a non-recourse loan. And just because you've had a non-recourse loan in the past, used it, paid back the credit, doesn't mean that it's always the case that non-recourse loans never have consequences. Right? Like James says, there's never a problem until there's a problem. So, no. It is the case that a policy loan is the only credit instrument on the planet where the lender is the guarantor of the value of the collateral. That means the company knows they're going to get repaid. That means that they don't have to compensate for that risk of default by padding the interest. And very fun things follow from this very elegant setup. And here's some of them. With policy loans, there are no applications. You instruct the company. Nelson used to say, You tell the gophers at the life insurance company to send me a check. So you're not asking permission. There's no credit check or even credit reporting. I could talk to you for 3 hours on credit scores and credit reporting. The idea that some institution that some of us can't even name, that are run by people who none of us can name, who probably don't like us anyway, is going to label our creditworthiness with a score, and that's going to determine whether or not we can get access to capital. Like, what? Now, economists will come to the defense of all this. They'll say, oh, it made lending much more efficient. Well, great. To whose benefit is that? Would it be the cartelized commercial banking system? Not that getting access to credit's a bad thing, but when the provision of the banking function, when the provision of credit is controlled by the most politically intertwined industry entity on the planet, is it a good thing to contribute to their business? I don't know. In the event, regardless, in policy loans, there's no credit check or credit reporting. There's no qualifying for a loan. There's no going through loan underwriting. There's no restrictions on what you can use the money for. How many businesses were never started because someone had an idea that didn't fit into the underwriting guidelines of the 30-year-old commercial banker? Yeah. We don't realize how conditioned our economic life is because we don't have control over the banking function. But in life insurance with policy loans, there are no use restrictions. So if you have an idea, something that other people don't, you need access to money to get things up and running, you can take a policy loan. Of course, there's no mandatory repayment schedule. Sometimes people will ask me, well, how, what's the monthly payment? I don't know. You tell me. You're the banker. One of Nelson's rules, don't steal the peas. Have a plan for repaying policy loans. I agree. That's got to be balanced, though, with the knowledge of your contractual authority. Maybe I don't make any repayments for a year or two. Maybe I don't know. I don't know your line of business. Maybe it's going to take you 18 to 24, 36 months to generate actual financial surplus, generate profit. You decide. You're the banker. And this lovely thing, no interest amortization. I should have put on here, this last point, no mandatory repayment schedule. They're unstructured. Right? There's no such thing as a 5-year policy loan or a 30-year policy loan, like a 5-year auto loan or a 30-year mortgage. And there's no specified duration. There's no structure to the repayment schedule. When we have structure to a repayment schedule, we get this nasty little thing called interest amortization, where the company the lender decides how much of your repayment goes to their pocket in the form of interest and how much goes to equity on the property that you use the credit to buy. Guess how they position that in favor of you or themselves. Yeah, but dividend paying whole life insurance is the worst place to put money. All right, loans are loans. Loans have interest. And people ask me about what's the current rate on policy loans? The first question is always, what's the rate on the loan? Never, what is the nature of the interest rate regime? Never, do my repayments go to principal or are they amortized? It's always the rate. We got to get away from that rate thinking, y'all. Look, policy loan interest rate regimes can be fixed or they can be variable. Typically, if a company offers policy loans at fixed rates, then the company will typically treat that policy with direct recognition. If the company offers loans at variable rates, the company will typically treat that policy with non-direct recognition. We'll talk about this next time. Just understand, since we're talking about interest, we got to mention that here. This is generally the case. If I can get loans at fixed interest rates, my policy is probably treated with direct recognition. If the company's going to tell me what the interest rate's going to be and that rate can change, my policy probably receives non-direct recognition. So here's the technical reason for why policy loan interest is so efficient and favorable to the policy owner. Okay, policy loan interest accrues daily, but compounds or is added to the balance only annually. During the year, during a policy year, whenever I do make repayments, those repayments go 100% to the principal of the loan, thereby reducing the balance on which interest will accumulate in the following day. Okay, so if I borrow 10 grand via policy loan, then there would be sort of this separate tabulation of interest accrual where on a given day, typically like midnight of the end of the day, there will be the loan principal. They'll multiply that times the interest rate times, it's actually 1/360th. Life insurance companies use a 360-day year. Times essentially 1 day. So times the number of days outstanding. That'll be your, the total interest accrued to that point for that year. So the total interest principal times, 0.05, let's say, times 1/360th. That's the interest accrued in that day. And we'll forget this number of days outstanding. We'll just cross this out for now. This is the daily accrual here. Okay, loan principal times the interest rate times 1. So then when I make a repayment, that repayment reduces the principal on which interest accrues the following day. Interest is paid at only 2 times in a policy year. Okay? Potentially. In the event you repay a policy loan in a given policy year, then interest will become payable. Right? You've repaid the loan, you fully extinguished the balance, the company sends you a notice, congratulations, good job. This is how much interest accrued given what you borrowed and given the repayments that you made. Will you please pay us? Now, technically, you can pay the interest, and I would encourage you to do that at that time. However, if you don't, which you have the authority to not pay that interest off, that interest will become a new loan. It'll be treated as a new policy loan balance. Okay, so that's if you pay the loan off during the year. Sometimes people ask me, well, if the interest is only added to the balance once per year on my policy anniversary date, what if I borrow money on day 1 and then repay the policy loan on month 10 before the end of the policy year? Do I have to pay any interest? Well, yeah. You had a loan outstanding for 10 months. So you'll pay 10 months worth of interest given how much you borrowed and given what your repayments were during that amount of time. Look, let me tell you this. Because your repayments go 100% to the principal of the loan, very often, I got to be careful how I say this, very often, let me put it this way, if you do make repayments during a policy year, the volume of interest payments expressed as a percentage of what you borrowed will often be less than the nominal rate on the loan. Okay, let me explain how I mean. If you borrow $1,000 on, the start of policy year 3, and you make no repayments from the start of policy year 3 until the first day of policy year 4, and on policy year 4 you fully repay that $1,000, and let's say your interest rate is 5%, then you will be charged in interest 5% of $1,000. What's that? $5? No, $50? Yeah, $50. And if you were to take that $50 and divide that into 1,000, well, you'd get 5%, right? That would be where the volume of interest dollars, the 50, expressed as a percentage of the loan principal, the 1,000, matches the nominal rate on the loan, which is 5%. Now let's add a wrinkle. if you borrow $1,000 on day one of a policy year at the start of year 3, but you make monthly repayments such that you fully extinguish the balance on day one of policy year 4, then the interest accrual throughout the course of the year will result in less than $50 of interest payable because you've been reducing the balance of the principal throughout the year, right? The nominal interest rate, policy loan interest rates are expressed on an annual basis. And so if you don't make any repayments, then the volume of interest dollars expressed as a percentage of the loan principal will match the nominal rate, the nominal quoted rate. But if you make repayments during the year, it must be the case that the number of dollars paid in interest will be less than it otherwise would have been. And if you were to take that number of dollars of interest payments, assuming repayments during the year, and divide it into the original loan principal, that percentage is going to be less than the nominal rate. I know, that's complicated, but that's how it happens. I have clients a farmer in Oklahoma, he took a policy loan to pay for some equipment. I looked at his report, as agents have the ability to do, and you can look at what the interest capitalization was. You can take the interest, you can divide it into the policy loan. It came out to 3.7%, and the quoted nominal rate on the loan was 5%. Why was the percentage of the principal that was paid in actual interest dollars, why was that 3.7 lower than the quoted nominal rate of 5? Because he made repayments during the year. So you really cannot compare. I think there's one more slide here. Yeah. Okay. When you go to the doctor's office to get a shot of some kind, the criteria is not the rate at which the medicine is injected into you. It is the volume. Too little, and it won't do any good. Too much, and it can kill you. It's not about the rate. It's about the volume. Right? So often I get those questions. That's from Becoming Your Own Banker, page 17, edition 5. I get those questions about what's the rate on a loan. It's like, well, I mean, it's what it is. It's what the company says it is. But then I got to explain all this for people to truly understand that why policy loans are so efficient and favorable to the policy owner. I go through that to tell you that you really should stop comparing nominal interest rates on policy loans with nominal interest rates on conventional credit. They are apples and oranges. By the way, this always used to confuse me when people would say, well, it's apples and oranges, right? It's like, it's meant to convey that you can't compare the two because they're different. And I'm like, yeah, but they're both fruit. It took me a long time to figure that out. I know, revealing my ignorance there, but we grow and we learn. But they really are different. Okay. Conventional credit repayment is either structured or unstructured. If it's structured, there's amortization. Yeah, just pull up a mortgage amortization table online. There's free mortgage amortization calculators. You plug in how much you borrowed, the duration of the note, 15 or 30 years typically, the APR, right? APR, by the way, is annual percentage rate. It is not the interest rate in the way we think of interest. When we think of an interest rate, we typically think of the amount of interest the amount of dollars I'm paying in interest expressed as a percentage of the principal of the loan. That's not what APR is at all. APR is made up. I mean, it's a creature of the Truth in Lending Act, I think of 1973. It's a subject for a whole other time. But, if the APR on a mortgage is 2%, but over the 30 years of the mortgage, I pay 45% of my repayments to the company in interest, then what does an APR of 2 mean? It is what it is. Maybe there's other value. I don't know. Again, there's this myth out there that, all you have to do to be able to do financial analysis is be able to tell whether one number is bigger than the other. And that's like supposed to be clever. Like, the APR now is lower than what it used to be. That's good. It's like, well, the house is worth more. Who knows what closing costs and origination fees are? What's the amortization table look like? it disguises things like this. And people kind of wag their finger with, don't you know, 2 is lower than 3. It's like, yeah, but that's APR. What does that tell me about the volume of interest dollars that I'm paying to the lender? Well, I don't know. Pull up an amortization table. Find out. It's not pretty. It's not pretty. So anyway, conventional credit can be structured. In the event it's structured, there's an amortization. There's a timeline, a specified duration over which the loan will be repaid. And given that structure, the lender can then allocate how much of your repayments go to them as interest and how much go to equity. And they rig it in their favor. What a surprise. Those with the gold make the rules, by the way. That's the golden rule. Nelson Nash, becoming your own banker. Okay, if conventional credit is unstructured, like a credit card or a home equity line of credit or a business line of credit, interest compounds monthly. You know this. Payments are due monthly. If interest built up, you don't make repayments, the interest goes to the balance. In other words, interest compounds 12 times per year. This will be important when we talk about non-direct and direct recognition and cash value lines of credit in the next lecture. But there's 12 instances of compounding as opposed to 1. Do I want my interest cost to compound more often or less often? Less. So a policy loan, in contrast to conventional credit, is both unstructured, no specified duration, and the interest only compounds annually. Why is that the case? Is that just the companies are giving you a gift because they're feeling nice? No, it's because there's no fear of loss due to default. Man, I get like chill. That's cool. If you're like me, and you're probably not, but that's neat. I want that. I want all my credit. The only reason we don't use policy loans for everything is because we don't have enough cash value. And we don't have enough cash value because we haven't paid enough premium. And we haven't paid enough premium because we haven't been doing this long enough, because our parents didn't do it, and maybe because our policies have certain riders that don't allow us to continue to pay PUA the way we want to. You see how all this builds, y'all. It's not about rates, it's about the volume. The volume of interest is lowest, all else equal, on policy loans relative to conventional credit. And I hope that my explanation for that has been clear as to why. You made it. Kept it under 90. Come on. Air high five. Next time, we're going to talk about non-direct recognition and direct recognition. We really had to cover interest rates on policy loans before we get to this. I'll give you some more. We'll go a little more in depth on the economics of what a dividend is. Punchline, it's compensation for ownership, economically speaking. Whereas interest is the price of credit. I'll tell you quite clearly, you might already be able to guess which one I prefer, non-direct or direct recognition. I do prefer one versus the other. It's very similar to this annually renewing term thing. If all we had were one option, well, then I'd sell policies that had that one option. But we don't. We have a choice. And so given where we are and the time and place, we're going to calibrate and optimize that choice. And then we'll examine some of the objections, why people might disagree with me. Sort of anticipate some of those objections, and I'll answer them. That's next time. Thank y'all for listening. We'll see you then.